to another episode of GorillaCast. I'm happy to welcome Risto Rautakorpi back into the studio once again. Welcome, Risto.
I'm part of the furniture.
Yeah, yeah. So today's episode, we're going to be talking about around the topic of valuation. And in your previous visits, we've talked about the topic quite a bit as well, but I think we felt that it would be good to focus a full discussion around that. And if we just talk about the valuation as part of the startup scene narrative as of today, how do you see that?
Well, it gets an awful lot of attention given that it's just a number, which doesn't really equal value. The value of the company is the cash amount someone is willing to pay for that. The valuation is just a number on the paper, but somehow that's become like the major goal, measuring the performance of the founders, and then they brag about what kind of valuation they managed to get, which statistically has very little, if any, correlation with the eventual outcome of the venture.
And if it seems that kind of the valuation of a funding round has become this celebrated milestone on its own, what kind of problems does that kind of bring to the company as such?
Well, first of all, it brings it puts focus on the wrong matter, because money is just fuel to the engine. And celebrating that, hey, I managed to get the full tank. Okay, well, EP, you can continue your race. But what really matters is that what do you do with it and what do you achieve with that? And focus should be entirely on doing meaningful business, serving customers, eventually reaching profitability and all that. And the money is just means to an end. So it's a resource that you need to use if it's feasible. But raising more money definitely does not equal success as such. It was success in raising funding, but whether success eventually results from that is a completely different question.
Yeah, and I think one of the things that we've talked about along the way as well is that the higher the valuation, the higher the expectation for your performance after that. So sometimes it can actually turn against itself, in a sense that you're raising the bar for yourself so high that it's difficult for the actual business to ever get to that level.
Well, yeah, definitely. Because in terms of valuation, the biggest issue is never this round; it's the next round. Because the price tag you set for yourself right now kind of sets the expectation for the investors. So the higher the valuation you ask, the more you need to promise to justify that valuation. The more you need to promise, the bigger the risk that you will not be able to deliver on your promise. And the bigger the gap between expectation and delivery, when the period ends, the more difficult situation you'll be in. So that's kind of it's a vicious cycle. You dig a hole to yourself.
Yeah, and I think one of the interesting things when you look at the statistics and something that we talk about as well is that raising multiple rounds of financing does not always, if ever, equate with success. So it seems that a lot of exited companies have actually done it with much less financing.
Well, most exited companies have never raised an A round. They may have raised some money, some might be completely bootstrapped, but again, the amount of money you raise and the eventual success at exit, and now in the venture investment context, success equals exit. But yeah, the amount of money raised does not increase the success rate of an exit, or does not increase your level of success to begin with. So raising twice as much money does not double your odds or succeeding or making it. Money does not buy success. If it would, the world would work in a very different way.
Yeah, and you mentioned previously there that when we look at valuation during the funding round, they're just numbers, not that meaningful. So could you expand on that a little bit for our listeners?
Well, the real value for the company is what somebody would pay in cash for that today. And for most early stage companies, that's close to zero, basically. So the valuation is just a number that you need to kind of get the the formula to work. And in essence, you are buying an option. As an investor, you're buying an option for the future success. But whether that's successful or not is only known after many years of hard work. So you shouldn't get tied up with the valuation as a number. It's just needed to get the round pulled together and so that you can move on. So the more experienced founders who have raised multiple rounds, their wisdom they share with less experienced ones is that the most important thing regarding a funding round is that you just get it pulled together as quickly and painlessly as possible and so that you can move on. That's far more important than the valuation and even far more important than the size of the round. So the people getting stuck with the valuation is just wasted resource. You spend energy on the wrong thing.
And you also mentioned, as you said, that when we talk about valuation, the problem isn't often what the valuation is this round, but what it means for the next round. So can you talk a little bit about that? That if you have a high valuation for the existing round, what are some of the implications potentially for future
ideally,
rounds?
Well, many companies raise more than one round. In the best case, you never need more than that one, or in some cases, you don't even need that, and then you can be completely revenue funded. But in the normal case, you will need more than one funding round, and the terms for this round kind of set the base level for the next round. And ideally, you will be on a positive curve all the way through to the very end, not on a steep ascending curve, but on a positive curve. But if you start from a too high level and you cannot deliver on the expectation, you hit a brick wall, and then in the worst case, you may have to do a down round, which is not the end of the world. If you have to do it. But then you need to adjust to what the real valuation should have been, and that hurts the most the founders themselves, and then the second most the early stage investors. So rather be realistic with the parameters early on to avoid those kind of painful adjustments later on, because if the case is not priced correctly, sooner or later the market will correct it. You can't avoid it.
Yeah. And in those cases where it hits the founders, hits the early stage investors, it can severely impact the cap table altogether and make it a more difficult investment case for future investors as well. Well, if we're then talking about kind of the way that we have been looking at the world at Gorilla, and we talk about this camel type of companies, I think it would be good to give a little bit of a reminder to our audience that what are these camel companies that we're looking at?
Well, camel companies are the ones who try to be as self-sufficient as possible and which use all the resources in a very economic manner. So you are capital efficient. You only raise as much as you need, no more but no less. So you need to have enough to get to the next destination, but you need to be lean. So the right amount of funding, the way I describe it, is that you need to have kind of a healthy shortage. Unhealthy shortage of capital means that you don't sleep at night because you worry about how can you feed your family tomorrow. And that's not productive. That forces you to spend energy on wrong type of things. But healthy scarcity, healthy shortage, means that you have way more things you would want to do and which you even think that you have to do than you can afford. That forces you to prioritize very effectively, which means that the marginal return on every euro spent will stay high. And you should never go beyond the point where the marginal return on the additional euro spent starts to decline. So being capital efficient, using the resources very sparingly will endure. Will help you to endure. Will increase the odds of you actually getting to the destination, because the road will always be longer than you thought.
Yeah, and I think in relation to that, oftentimes if you are building your business that way, you're not really losing any potential alternatives for the building path of your company,
No,
but you are actually keeping your options open longer.
very true. Because you should always defer all those kind of decisions that close down some options from you as far as possible. So keep as many options open as long as possible. And for instance, raising a large amount of funding at the high valuation already closes many potential avenues going forward. So then you are locked on a road with no return. And that often is a very risky road, so your chances of actually making it are not very high. But once you have made that decision, you have no alternative. You have given up the alternative path. So no, you should always be in a situation where you have alternatives to choose from.
Yeah.
And from that perspective, being self-sufficient is of course brilliant, because then you always have the option of being just revenue funded. You don't have to raise. You only raise if it makes sense.
Yeah. And just opening that up a little bit so that it doesn't sound too theoretical. So every time when you raise a larger funding round, essentially what you're doing is you're raising the floor of a meaningful exit value, because the more money you have taken in, the more bigger part of your company you've given away, and the larger the expectation is from investors as to what they would expect.
Yeah, well,
as a
the
positive
bar for
outcome.
what will be considered as a happy end by yourself and by your investors will be higher. So nothing more than the top price will satisfy after that.
Yeah, and I think nowadays you can read a lot of stories about fairly high valuation company exits where the founders have been left with practically nothing, with all the liquidation preferences and anti-dilution clauses that there have been in the documentations.
Well, yeah, unicorn is not that old of a word, but now there are some newer relatives to that word called zirpicon, which means that unicorns that are a result of the zero interest rate policy era when money was basically free. So it helped to inflate the valuations. And papercons, which is companies which had the valuation. And this actually is a good example to make the point between valuation and value. The valuation was high, but the value never got there. So they only ever had that unicorn figure on paper, but no one ever paid cash at that level, which means that it meant nothing.
Yeah, very true. So I think whenever you're building a business, and I think this is one of those things that gets discussed within the startup circles quite a bit, that there's no way for you to build a new business without taking risk. But I think there are multiple levels of risk you can take. So what's your take on de-risking, building your business, and what's kind of smart risk taking, and where do you draw the line?
Well, I guess it depends on your personal risk appetite and your risk aversion characteristics. So what type of risk hurts you the most? For some people, even small downside risk hurts a lot, way more than an upside potential that you gave up. But for some people, taking a hit to the downside is acceptable if it allows you to have at least a theoretical access to a big upside. So it's also it all is a very personal matter, but de-risking the project as such is a key concept, and it starts from identifying where your biggest risks actually lie and what is the cheapest way to de-risk it. So where do you get the best bang for buck in terms of spending resource versus the de-risking effect. So you should understand that, and that actually is part of being capital efficient, because then you know where the money yields the best, and then you only spend it where it actually gives you a measurable benefit.
Yeah. So and I think that's a valid point. Oftentimes, when you're talking about building a business, there's spending money is not good or bad. Spending money where it counts, where it brings you value, is the smart thing to do. And as you were saying, that the clearer you are on what you need the money for, the more efficient you can be in deploying that money. You were talking a little bit about kind of the role of valuation, and in kind of Gorilla's philosophy, we oftentimes talk about this concept of one milestone at a time. So if you expand that type of thought process towards funding, how would you
Sure.
describe it?
Well, the journey from start to finish is long, always longer than expected and harder than expected. Uh, and how do you eat an elephant? You take it one spoonful at a time. And so you need to divide the overall trip into legs. And right now, you don't need to see beyond the initial leg. So you need to identify what is your next milestone you need to reach. What do you need to have when you are there? What do you need to have achieved by the time you get there? What does it allow you to do when you are there? What makes your case better if you reach your goals? And then you calculate from there, okay, what does it take for me to get there? And that's what the first leg consists of. It's these kind of activities, these type of things I need to invest in. How much money does that need? And then focus on that. And raise enough to get to the next milestone. Once you are at the next milestone, you'll hopefully be a lot wiser because you have learned a ton during the first leg of the journey. Based on that, you will adjust your parameters. Then you learn the things that you didn't know when you started, and you can act accordingly and make wiser decisions going forward. Then identify the next milestone, and then orientate for that, raise what is needed, and eventually you'll get to the finish line one day. But you don't typically know in advance where the finish line actually is. And like I said, the journey is always longer than you thought. So you need to rather make the money last longer than shorter, because you may need to wait for the finish line longer than you initially thought.
Yeah. And I think that also brings back the point that we've been talking about during multiple GorillaCast episodes, that the faster you can reach cash flow positivity, the more flexibility you have also in raising your funding, because then you're not forced to raise at any one given point, and you can make strategic choices when is the right time to taking the money. But I'd like to come back to kind of these milestones, and that thought process makes sense. So could you tell some of the elements of good milestones that you've seen along the way that make it easy for you as an investor to say that, okay, that's something that's worth investing into?
Well, it starts from the founder having a humble attitude, accepting and internalizing that there's a ton they don't know. And not knowing is okay when you know you don't know. And then when you're geared up to get the answers, rather than speculating and guessing. So when they have identified that now I'm here, and eventually I need to go somewhere there, but the first milestone I can now visualize, and for which I can put the coordinates, is that. And I need to have X, Y, and Z at that point. Okay, what does it take for you to get there? Well, I need to do these kind of tricks and experiments, and it will take X months, and I maybe need to hire one or two people, and blah, 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 blah. But they're going to know what they're doing, and they have clear measurable targets, which doesn't mean that when you're done, this is all done and finished. No, but you have reached the next milestone. You will have knowledge, assets, visible results that you don't have today, which will then contribute to your pool of assets, and it will make your case stronger in the eyes of the investors as well. And it also helps to put the valuation up because, hey, you have learned something. So you are that much closer to crossing the finish line. So that's worth something.
Mm-hmm. And I think you alluded to a little bit earlier into this notion that sometimes slightly underfunded companies, so companies that don't have excess money, they have enough to perform their activities, but still being very tight with the funding, they often perform better. Why is that?
They cannot hide behind money. Money is the easiest solution to all problems in the world. If you happen to have it, just throw money at it. But that just hides the problem, doesn't fix it. So the startups which don't have the excess money, they are forced to face the issues head on and figure out the things that ultimately are keys to their success. So actually, too much money will act as an insulation layer between you and the real problem. So rather than throwing money at it and trying to avoid something that might feel unpleasant or something, no, you need to go where it's hottest, head first, to figure out the issues. So not having money forces creativity and forces you to do the things you might rather avoid, but which are the necessary things you need to do for you to find the right answers.
Mm-hmm. So really to find the focus, really to do the right things, having kind of smaller funding makes it kind of or forces you to be more focused on the
It
right
does that,
things. Yeah.
and it also avoids distractions.
Yeah.
Because if you have money, one thing that is guaranteed is that you will spend it, and you will have no shortage of ideas. And if you run out of them, people will tell you where to spend it. And then you will be busy with those money spending activities, which look like work, but in a way they are kind of fake work, because you might be busy with them, but do they actually move your case forward? Do they actually contribute to the stuff that ultimately matters? So not having the excess money avoids those kind of distractions and makes it easier to stay focused on the core.
Yeah. And I think one of the aspects that is fairly clear, but often gets overlooked is when you're raising venture capital, essentially you're sharing a goal with your investor that you're going to aim for some sort of a liquidity event. So that brings kind of this thought process into, well, at some point you need to end up with some sort of a meaningful outcome, some sort of an exit event. And in order for you to get there, you need to learn. And I think this is one of the things that we've discussed previously as well. But it seems like money doesn't make you a faster learner, or does it?
No, and actually it might even slow you down because of the distraction activity. So it takes your attention away from what you really should be dedicating your attention to. Yes, startup is a learning project, and the startup's job is to find answers to the questions where no existing answers are available. And money doesn't do that. Money might be a resource that allows you to do certain activities that you need to perform in order to find the answers. But money alone is not the solution. It's just an enabler to some extent. And again, too much of the money easily results in you just spending it unwisely. So doing things that don't actually move your case forward, don't really add anything to it. You just do more of the stuff that you already know, or you do stuff that wasn't really necessary or something. So the key KPI, if you will, should be the learning, and money and learning are not really correlated.
Very good. And one of the things that I think we've clearly seen, and there are multiple stories out there, that when you have excess capital early on, it oftentimes leads to you to start trying to scale too early before you found product market fit. And that's not a good thing to do, is it?
Well, no, definitely not. Number one reason why startups die is premature scaling and premature funding typically triggers you to do the premature scaling. So you just try to force things with money, but it doesn't work that way. So you can't buy success with money. No amount of money will force your customers to buy, will create the business. But having the money allows you to spend time and effort on things that allow you to avoid seeing the truth. So I'm hiring salespeople, I'm spending money on marketing, I'm doing all those things which should result in business. But if you didn't have product market fit to begin with, that didn't help. And you just wasted time and money.
Yeah. And I think one of the things that you've talked about oftentimes as well is that you've been getting a lot of testimonials from founders who have been getting a lot of money early on and not really known what to do with it. That if they were to get that opportunity again, they would do things differently. So what are some of the things that you've heard in terms of how to treat money in an early stage startup?
Well, money is a resource you need to learn to use wisely, and it's a skill like any other skill. So you go one step at a time. How do you teach your kids to deal with money. You first give them some coins, and you start from the low level, and then as their comprehension hopefully grows, then you can give them access to some bigger tickets. But if you get too much, if you get more money than your abilities allow you to too early, then it has resulted in a waste. So a quote I often use is a direct quote from a post-mortem one of our Fund 1 founders did after his company, which was relatively successful by the standards of the time, but went bankrupt. And in his post-mortem, he wrote that, now if someone gave me the million, this time I would know how to use it. But he didn't get the second chance because he blew the one chance he had. So he should have learned first before he raised the million. And one thing I have asked from quite a few of our founders who have reached certain level of success, there's some kind of product market fit, they start getting into the real business. And I asked them, okay, so what would have helped you to get here faster? No one has ever said that more money. It's never about money. And I have sometimes directly asked, so if you had more money, what would that have changed? Nothing really, or nothing for the better anyway. So the critical issues that have determined their success have never been about money. They've been about the ability to understand the customer, having insights, executing stuff that money wouldn't buy.
Mm-hmm. Very good. And in that sense, if we have been spending this session talking about that kind of, there seems to be too much of a celebration of funding rounds being raised. If we were not celebrating the fundraising rounds as funding is just fuel for you to do what you're doing, what should be the things that we should be celebrating and focusing on?
Well, the first paying customer, the first cash flow positive month, the first dividend you eventually might be able to pay, because that's real value for yourself and also for your investors. So those are the real measurements of success. So fundraising is just a tool along the way. And yeah, I'm definitely not against raising some funding and using some capital. Not having any is an unhealthy constraint. That is not optimal either. So yes, you in cases where the money does buy you some resources that help you move faster, use it wisely. But the key thing is to understand what is enough for what you need to do. Mm-hmm. Because doubling that amount does not double your success.
Yeah. Very good. So if we start wrapping these things, what would be some of your kind of core advice for founders when it comes to funding?
Well, critically analyze and identify what is the right amount of funding you need. But I say right amount, not too much, not too little. Because if a plane has only half tank of fuel when it takes off, that's a suicide. Don't do that. So you need to have enough money to get where you need to go. But that is just the first milestone, not all the way through, and not for the next 3 years. But, well, in our context, in early stage startups, normally the meaningful length of the first leg is roughly 12 months, 12 to 15 months, because you can't really see beyond that. So identify, okay, what is my target there? And then what is the money I need in order to get there? And assess that from both perspectives. Is it enough? Is it too much? And that's a healthy starting point.
All right. And then if kind of you're essentially saying that kind of when you're trying to assess what's the right amount of money that you need for the next leg of the journey, then you should have some sort of metrics that would help you assess how you are moving towards that milestone. And we talked about those a little bit as well. But it seems to me that it's oftentimes difficult for the founders to come up with the right metrics, and oftentimes you're focusing on some what we would call vanity metrics and things like that. So how should the founders go about trying to kind of come up with meaningful metrics when it comes to evaluating the milestones?
Well, it needs to be a derivative of how you define the coordinates for your first milestone. So what do you need to have? It could be that I need to have 5 paying customers as a result of having talked to, I don't know, pick a number, 20 or 30 or whatever, and I have been able to figure out whether thing X is A or B.
Mhm.
Okay, well, once you know that, you'll be much wiser, much better positioned to plan for the next leg. And then during the initial leg, when you are working towards that, did I do something today that made me move one day closer to that goal? Do I have anything to show for the work done today?
Yeah, very good. And I think one of the things that that we always also like to highlight is that we would like to see the founders to build the business to last in the long term, not to build it just to raise money. So once again, highlighting the fact that raising money in its own is not a goal. It's just a
not the
means to
reason
an
to
end.
exist.
Yes.
It's not the reason startups exist. Definitely not. The startup exists in order to solve a meaningful problem, serve customers, to do something productive. And money is just a means to an end. It's fuel to the engine, nothing more.
Yeah. And then finally, going through the full circle, we started talking about the valuation and why kind of the valuation for a single round is not a determining factor for the company's success. So I think that's a good place to close as well. That until you get to that actual exit event, it's just paper valuation. It doesn't mean much, but the risk that you face if you raise too high of a round is much higher than the risk if you raise with slightly more moderate valuation.
Yeah, well, the only round where the valuation really matters is the exit, the liquidity event, where real money is moving and actually in the right direction. You as a founder get money and also your investors. So focus on that. You should optimize for that. So the funding rounds in the interim are just like stops at the petrol station or something. So whatever the figures are there are kind of irrelevant. The thing that matters is that what do you get at the finish line?
Mm-hmm. Very good. So thanks so much for our discussion today, Risto, and we'll continue from here.
Okay.
Thanks.
Thanks.
Bye.